What up, nerds? Can you hear me properly? Yeah, I think so. Cool. Hey, thanks for joining today. I'm just gonna do a short opener intro. We got a great panel here. Degen's experts, people in the space, hacking, maving people out of their, whatever. And I just want to say a few words maybe about Swiss. So guys, if you haven't heard, if you're building something, hacking on something, researching something in DeFi that's interesting or relevant, check it out, Swiss style. We are in Zurich. We're builders. We're hackers. We're building on protocols. We are hacking on hackathons right now. Just have to jump right back to get back to that stuff as well. And yeah, we do educational stuff, workshops, events. So join us, talk to us. We are here. A few of us are. And yeah, thanks for joining the panel. Henry, you want to take it?
Lovely. Thank you very much, Amin. Welcome to the DeFi Roundtable here today with some of my good guests and some of my favorite people in the world of DeFi in Switzerland. Welcoming to the stage, we've got Magnus from TX91, Connor from Enzo. We have then Dr. Krzysztof, Dr. Chris himself from the UZH Blockchain Center, Nicolas Alioth, who is a biased favorite of mine, my co-founder for 512M, and Colin as well from ClearStar Capital down in Pfaffikon. So, welcome to the panel, everyone. I just wanted to kick off with our first set of questions here and a brief introduction from all the panelists. If we can start with Magnus, that'd be great.
Sure. So, I'm Magnus Woodgate from TX91, self-created prop shop. We're big in the MEV DeFi space. Yeah, algo traders, really.
Hi, I'm Colin, the co-founder of Enzo. Enzo's a DeFi aggregation layer. So if you're wanting to embed DeFi actions ranging from lending, borrowing, swapping, LPs and vaults, you can simply just use our API. And we're solvers of intents as well.
Hi, my name is Gogol. I'm actually still a PhD candidate here at University of Zurich. I'm researching blockchain, decentralized finance, and recently also rollups. I'm also a tech entrepreneur and one of the co-founders of DeFi AM community in Switzerland.
Hello, everyone. I'm Nicolas, as Henry said, co-founder of 512M. We're a Web3 research and advisory company that specializes in things like tokenomics and decentralized finance. So we've been in the space for quite a long time, and we're both coming also from a more traditional finance approach to kind of try and bridge the gap that's getting smaller and smaller between both of these worlds.
I'm Colin, and we run mostly market-neutral yield strategies, but open to all kinds of other quantitative approaches to run in crypto. Doesn't have to be DeFi. My background is in centralized exchange market making, and also a lot of experience in sort of the TradFi world of fund structuring, both for illiquid and liquid vehicles. So yeah, quite broad in that sense. Henry, up to you.
Perfect. Thank you very much. Now, just to jump in and start very quickly and aggressively, we've all seen the world of DeFi, the developments that have been moving forward from basic AMMs on constant product all the way into concentrated liquidity. And now we're seeing some incredible developments in the world of dark pools and request for order flow. My first question to start off the panel is, what do we think about the world of dark pools, and how do you think it's going to impact the liquidity and price discovery mechanisms in the world of DeFi? I've got to start it off with Magnus, our favorite man in the world of dark pools.
Yeah, I think we spoke about this before, but basically the world of dark pools and DeFi isn't really there yet. Please feel free to interrupt me, but the only dark pool I'm aware of right now would be the Kraken CeFi dark pool on crypto. Although, yeah, I mean, because at the end of the day, everywhere else in DeFi, you're going to be able to see the kind of liquidity. Essentially, we're talking about the solvers being a kind of dark pool because you don't know what liquidity they have until you actually execute the trade. But yeah, I mean, I think there's interesting developments like a Panther protocol, I think they're called, doing zero knowledge proofs to verify that there is liquidity for you to execute that trade without you actually knowing the liquidity. But I don't think there's anything else there just yet. I think maybe over the next couple of years it might become a bigger space. I mean, it's quite big in TradFi, so. Yeah.
Exactly. I'm just wondering where we're going to start to see these kind of parallels that we have in the world of traditional finance, and whether we're going to start to see some of the dynamics that we see in traditional markets, maybe in the world of RFQs and how it's developing. Colin, have you got any interesting alpha in the world of the RFQ space for DeFi?
I think RFQs can definitely take a lot of market share away from AMMs, which turn out to be not very efficient, even with concentrated liquidity. It's just not a suitable mechanism for price discovery. I guess for executing swaps, it's kind of all right if you don't get meffed too much, but I think RFQs can definitely offer a both better price for the users while also offering sort of a mechanism to bring the price discovery from the centralized exchanges to the decentralized world more efficiently than AMMs, because with AMMs it only works through executing swaps that update the price. So I think, yeah, RFQ is definitely something that could get a lot of traction and growth over the next couple of months, or sort of for the next part of the cycle as well. As more and more LPs on AMMs probably realize that they're just bleeding money. I haven't met any LP strategies for volatile pairs that is really profitable. So there's a few people that claim they solved it, but I don't think there are. But yeah.
Colin?
Yeah, I think RFQs are quite common nowadays, even within like intent protocols like Uniswap X. People assume it's like a decentralized solver set, but it's not. The first 95% of all orders go to private market makers. And the question we should really ask ourselves is, do the users care where the funds on the other side come from? And the answer is not really. They just want to get the best executional price. So you can see this, let's say, solver model in CowSwap, one is Fusion, Uniswap X, and so forth. A lot of the order flow is still going through RFQs. Now, the topic of decentralization also comes up in this. Okay, if these are centralized market makers, it's not fully decentralized, but you'll still have the AMMs, you'll still have the DeFi protocols for more niche tokens like meme coins. RFQ providers will never really do RFQ quotes on them.
Yes, I mean, I agree with you guys that actually the more options traders are having, it means simply the lower fees they are having, but also with the dark pools and also liquidity off-chain, actually traders do not know whether the price is the best possible price they are receiving. And here we really need zero knowledge to make sure that simply nobody is being cheated by an algorithm or some code which is running outside of the blockchain. I mean, it also, so there are some cases when the same protocol, the same company is running a solver and, for example, the order book, then, I mean, in such situation, how do you know whether the price you're getting is really the best execution price? I mean, it's cheap, but is it really as cheap as it could be? And here, yes, zero knowledge is perfect.
I don't know. I think that's why protocols like CowSwap, One Fusion, they exist, right? So you're not trusting one party, you're trusting a network of 20, 25 different solvers. So kind of that problem to some degree is being solved. If you go like exclusive order flow, sure, MetaMask aggregates different route providers, but do they really in the background? That's another topic. But you know, these networks like CowSwap, they do exactly this.
I think this is an interesting set of developments here. I think for the world of traditional finance, we're seeing now this increasing professionalization, as we see now with solver intents, new RFQs in this space, and the possibility of future dark pools coming out. But the question I always have then is, with this massive increase in complexity in the world of DeFi, do you think we're slowly moving slightly away from the mission of DeFi, or its purported mission, which is financial inclusion and equality, effectively, of participation for everyone? Do you think this complexity might be leaving a few people behind also? Or?
I think yes and no, because as complexity increases, the amount of solutions that reduces that complexity again also exists. For example, let's just take concentrated liquidity as an example. Back in 21, if you wanted to create a meme coin pair on Uniswap V2, very easy. Now you have to worry about ranges and stuff like that. But with that increased complexity, we've also seen the rise of protocols that actually address this. Like, for example, on Solana, we've got Camino Finance, which makes providing liquidity to a concentrated liquidity AMM very, very easy. So I think as the complexity increases, we will also see a rise of other protocols that actually reduce that complexity for people who want to participate. But I also think that when you look at the majority of the volume in DeFi, especially when you're looking at smaller pairs and more volatile pairs, it's not actually coming from liquidity provision, which is the more complex part. It's coming actually from the trade side. And here, again, if we use RFQs, if you use any front end or aggregator, at the end of the day, the retail user only cares that I can click a button, I know I'm getting, hopefully, the best price, and it's easy to use.
I mean, yeah, I would argue that it's never been that friendly. I can't remember which talk I went to. Someone said about people managing their own private keys and then asking the audience how many people actually use Linux themselves and manage it themselves. it's kind of the same thing. Like, that's why you get all these custody solutions and all kinds of stuff like that. And I think the complexity is growing, sure. But I mean, like Nick said, along with that, you get some great solutions like the solver stuff. We didn't even mention that it's gasless, right, for users. So now they're not paying gas anymore on their swaps. Yeah, I think it's, yeah, but I mean, how many people who traded original Uniswap V2 actually knew how constant product worked when you executed it?
That's a fair point, fair point.
Actually, there were some studies that most of the people, retail investors, they do not know what impermanent loss is, and 80% of those early yield farmers actually lost money by doing yield farming. I think that already DeFi is far too complex for the retail investors. It's like when you go to some yield farming website, which is not trusted, and you see 60% return, then okay, when the crypto is going up, then yeah, you will see more money. But the reality is you could make more money doing something else. And I think that increased complexity is actually a very good thing for you guys, because you are professional crypto asset managers. And I think that the retail investors, shouldn't do it by themselves. They should go for the professionals.
I agree with you. It was never. Oh,
Go ahead. Like the promise of AMMs was also everyone can be a market maker somehow, but of course that doesn't mean they can be profitable. And with the solvers, you have a lot higher barriers to entry, so you need to be fairly sophisticated and basically need to be a professional actor to execute that. And there's of course no solver that offers that yield or the return back to the retail crowd. So they can maybe execute at very favorable swap prices, but they don't get any of the return that's basically creating that market. So they cannot participate in a sense.
No, a little closer. I think it's just
okay.
Quiet. There we are.
Okay. Anyway, you heard me.
Go on, yeah.
I agree with you. It was never easy. And I think with these more intent networks that are being spawned up, it abstracts all of the logic away for the user. You know, like if a user wants to go into Beefy Pool, that Beefy Pool may need like an Aura pool that requires a balancer pool that requires 3-4 different tokens, right? Now with these intent networks, you can just submit and say, hey, I have A and I want B, C, and D. And then all of that logic for how to interact with it is abstracted away. So I think over time, it will actually get more simplified because we're a little bit deep into it, but if we abstract it away for all these different retail users, and then these retail users, the wallets they're on, are then using intent networks underneath, I think we could see more adoption into DeFi without going to 4 or 5 different interfaces.
Just a comment on that. I mean, when CalSwap was developed, the batch auction, coincident of once intent style stuff kind of came from TradFi, right? From the SEC 615 or whatever. And I think that the whole intention of that development in regulation was to provide clarity to, normal TradFi users when they're executing options trades, who actually fills them and where does the order flow actually go. And I think I don't really know, because I would just say that TradFi in that regard is more mature, right? Because they've been doing it for longer. And they did these things to make it clearer as to where the trade goes. But then I guess, we're having the same thing in DeFi, we've just copied it, right?
You obviously read the article from Flashbots about order flow.
Yeah.
STC rule.
I mean, it's like anyone can look up the order flow, but is a retail user going to understand what they're looking at?
But they don't need to understand order flow. The user only has an intention to go from A, B, and C, D. All that other magic underneath is gone. So it's just user explicit in their intent. It's not that they want to know the order flow. They just want to get from point A to point B, and that's it.
Sure. I mean, it goes back to the point of was DeFi beginner friendly to begin with, right? So it makes it easier, yeah.
Here, I mean, I agree with you. We should distinguish between making user interface and UX actually easier, which is happening currently in DeFi, versus the complexity of the underlying things, which is getting far more and more complex. And it's not only complex to understand, but also you simply need to be full-time in that business to understand what's going on.
Well, as usual, everything continues to get slightly more complex, but for, of course, the institutional embracement, it's quite nice for us to be able to justify our own positions, obviously, which is quite good, of course. But with some of these increasing complexities as well, I think Colin just brought up a second ago, in the world of order flow also, about any developments that may be coming in the world of payment for order flow in the space of DeFi exchanges also. Just seeing if anyone's actually seen any new developments in that space or how they see it moving towards.
I mean, I went to an interesting talk from the guys from Volantis. I'm not sure if you know.
Yeah.
They're launching, this is not shilling anything, they're launching a new protocol for solvers, but the idea that was unique was that you, as a solver, you get rewarded for providing up-to-date price data, so that if you're, for example, like Uniswap V2 or V3, if the price was wrong compared to Binance, someone, a sophisticated market maker or solver, would be able to identify that, and they're going to get rewarded by updating the price on the exchange, so that the user and the everyone around it, basically there's more information being given to the users of the platform, which is incentivizing institutions to, it's kind of, well, the great thing about blockchain, right? Mm-hmm. The whole point is you incentivize everyone so that it works out best for everyone. Mm-hmm. So I think that's a really good example of that. So it's like you're being paid for your order flow, which is also helping retail in that sense, yeah.
Coming back full circle, exactly. Anyone else have a comment in the world of payment for order flow, or is it just Magnus over here in the world scalping?
No, I think it's also a question of how much of that is routed back to the users, because there's a lot of wallets that sell their order flow. Like if you execute a swap through MetaMask, I'm not sure where it ends up, but you can find it out. It's I think it's also in the Flashbots article that Magnus quoted before. But yeah, and a lot of that money that they receive from selling the order flow, that stays with the wallet provider and doesn't go back to the user to give them a better price or anything. So that's also, I guess, a question of how aligned are the incentives in that.
That's a fair comment, I suppose. But then incentives in this space are always quite nice on two sides. It depends. We always talk about the curve incentives anyway. But I was just wondering then, of course, what's the potential implications here when we're looking at the world of payment for order flow about the user's privacy and transaction security there also? Does anyone have a comment for?
I can jump in.
Yeah,
because here, I think we should also distinguish between different types of the traders. I mean, if you are swapping tokens for $10, it's very different when you are swapping them for 10,000 or 1 million. And generally, statistically, of course, those bigger trades are typically being under attack. When you are just like small retail investors, yeah, you are unfortunately too small fish that, they would bother.
I tend to agree, but I would also say that even currently, for the big players, anonymity is not really that much of an option anymore. I mean, unless you go through Tornado Cash and found a new wallet, most people, when they see a wallet with over 5 million in it, they have an idea who it is. I mean, we have multiple tools like Arkham Intelligence or Chainalysis, stuff like that, where you can then also look at all the trades that they're doing, also track what they're about to do, and kind of like know what they're up to, right? Because since blockchain is transparent to everybody, you can see what everybody is doing. And there are hundreds, if not thousands, of tools out there to track certain wallets, track activity of certain players, which is also, I think, the beauty of blockchain technology.
I think the question on privacy is, does the user really care? If you're going to give them 10% extra on their trade, are they going to choose to lose money just to be private? My assumption would be no. So that's on the user side. On the second side, on the solvers, you've got solvers on this table and they're public. They're saying that they are solvers, and there's a lot of reputational damage if you are maliciously front-running, sandwiching, back-running all these user flows that you're getting to you. And I don't think solvers are going to be that private. Solvers are the new MEV. We see the mempool before it even hits the mempool. And if we abuse that, then we won't be able to fulfill any orders on any other networks.
Yeah, I guess it's just the same thing. It's like for validators, right? I mean, there was a really interesting take I saw, which was about MEVers and opportunity cost of maliciously reordering transactions to see if you built that block, would the cost of the slashing justify it? It's just like the principal agent problem and how DeFi goes to try and solve that. With the layer ones and the validator model and the block builders and now the intents. Basically, I think there's probably some more developments that we don't even realize that are going to happen yet there. So.
Well, as you mentioned there, exactly with the principal agent problem, I think we're going to jump straight into the next topic here, which is, of course, we've talked about already the incentives and the alignment of incentives in the world of DeFi. Of course, apart from farming incentives, often these incentives often go wrong. And the idea is here, of course, bringing it back to institutions. Do we think that the world of institutions coming into DeFi might contribute something to more robust or strong governance models and incentive models for the world of DeFi?
I think so, yes, because when you're looking at governance, I think generally, not even in DeFi, but in blockchain in general, at the moment, and I still think it's going to be a problem moving forward, is very often you have less than 5 players holding over 50% of the supply, so any proposal that goes through does get accepted instantly. However, I do think that even if a large portion of these powerful holders are an institution or a group of people, it does bring a bit more robustness than if you had, let's say, Sifu holding 20% of your governance token, and then he just decides to crash your entire protocol.
But I think it brings up a good point that I don't think that bringing institutions in necessarily brings robustness, at least the traditional TradFi institutions. I think it leads to a lot of centralization. I mean, now that you have Uniswap v4 with KYC pools, I mean, come on, like, and other things like Athena, centralizing that there, and you need KYC to use Athena right now. It just adds a lot of layers of KYC and the robustness, because I feel like the robustness comes from, in a TradFi worldview, the robustness comes from centralized authorities, right? Because if you are centralized, you have control if something goes wrong. But yeah, and that's the way it's always been. And you see like a lot of these institutions coming in, like even with solvers, it centralizes the order flow to the best solvers, right? So, yeah.
I think what institutions are also bringing is a little more pragmatic approach to DeFi. Because especially early, let's say, adopters of crypto, they were driven by the ideology and also by the message, by the mission of different protocols, and that a community was very important. Whereas when you have the, especially financial institutions, they just look at the returns, and they are also doing their own math, so that they don't believe into what those protocols are claiming. Yet they recalculate it, and they simply invest where it really makes sense.
I think it's also important to differentiate between governance robustness and just general robustness of any protocol. And that's where I think like some institutions might be a bit of a threat because, for example, one of my favorite protocols is Liquidity. And try explaining to a big traditional finance institution to say, oh, we've got a product and we're just going to release it and throw away every control that we have over the smart contracts. Most people are going to be like, what are you talking about? This is nonsense. But that's also where I think we have to be careful when certain actors coming into the space, that we don't lose, like Krzysztof said, that ideology of openness and trustlessness.
Well, that's the difficulty, I guess, when you're talking about DeFi in the world of institutions and the natural centralization effect of people who are simply executing better in the world of, say, on the solver side. Just, of course, it goes to the best performer. And, of course, sometimes that does centralize things. Do you really think that the integration of institutions into DeFi will keep DeFi D? Is it really going to be decentralized in the future? Do you think it's going to stay like it is right now for the next 5 years?
I think if these protocols themselves will still be decentralized to a certain degree. The other question is, are DAOs really DAOs? If teams can vote on it, the foundation can vote. It's not really decentralized, right? And we think DAOs are great. Some degree they are, but if we have more centralized parties coming into this and certain teams still have the multi-sigs to control, let's say, Chainlink or other protocols or bridges, then maybe they could take over this, right? So we think DAOs are good, but maybe 4 or 5 years, this is a great entrance for centralized parties to hijack protocols. And I think Liquidity, like you were saying, is a wonderful protocol. I think they're thinking 5, 6, 7, 8, 9, 10 years ahead on this attack vector.
I would say it depends on which layer you look at for the centralization, because, for example, you could say the Ethereum validators are centralized because most of them use the same software, right? Or you could say block builders, there's like plenty of block builders, so you could say it's decentralized, but only 2 or 3 of them fill almost all the volume. They process all the blocks. Yeah, and I guess it could quickly, like it's a unstable balance. It could very quickly tilt into the very centralized part where you have maybe enough entities involved, but literally 2 of them controlling the market. And the other ones are just like 1% of the market, and the two biggest ones are 99%. So I don't know. Yeah, what do you think?
I think it's also important to differentiate between centralization, where it is centralized, and there is the capabilities of decentralization. I remember back when Tornado Cash was first put on the OFAC sanction list. I think like 99% of blocks produced were censoring transactions coming from it. But at the end of the day, it didn't really matter because the 1% still existed. Meaning, sure, if I'm putting in transactions through Tornado Cash, I might have to wait a few minutes longer, but there is somebody somewhere out there who will actually process my transaction. Meaning that even if 90% of things for something is centralized, just because you have the capabilities of another actor coming in and being like, oh, there is a whole untapped market for a certain service, I can come in and actually serve that market. I do think that this is something that should not be ignored.
I think it's also important to distinguish between different types of decentralization. Like, first of all, you might have smart contracts that are running on the blockchain, and simply DeFi protocols are such smart contracts. And this is what the word decentralized finance coming for. They have a lot of cool properties, like what they can change the history, the logic is known to everybody. But there is another dimension, which is DAO and the governance, which is independent from the first one. And actually, already today, 90% of DAOs are centralized, which I would say it's normal in a free market economy, because those DAOs are typically startups, which are small enterprises. And it's normal that small enterprises are simply owned by their founders and investors. So I think that there is nothing wrong with that. It's important that we stay with that decentralization coming from the blockchain. And also when it comes to TradFi and DeFi, I think that DeFi needs TradFi more than TradFi needs DeFi. I mean, when you look at the amount of the money at TVL or trading volumes that are in DeFi today, they are extremely small compared to TradFi. I mean, for example, a few days ago, Uniswap announced that they process $2 trillion since their beginning, like a few years ago. $2 trillion. I mean, in comparison, FX market in TradFi is processing 7 trillion daily. So the difference in volumes and TVL is really huge. And I think it would be good for DeFi when simply all of that money, or maybe majority, actually move to the blockchain and those protocols.
That makes a lot of sense. I think the size comparison, obviously, we'd all love to see it go a little bit further up. It would help my fees, of course, which would be very nice. But that's the thing, with the TVL currently still below its all-time highs. And as you mentioned, the absolute gap between where we are in DeFi right now and where TradFi is, especially when you consider the FX market. Do we really think that institutions are playing with size in this market already? Are we starting to see processes from institutions in the world of DeFi so far?
I mean, I think there's several factors as to why it's not there yet. And you see, like with the Bitcoin ETF, right, that brought in loads of inflows. And after FTX, all of the on-ramp, off-ramps basically shut in one go. And I mean, they exist around, but I still think that, you know, there's this regulatory unclarity almost everywhere. And when you're working across different jurisdictions, you're going to see, well, just the challenges to enter the market. And like you say, because the volume's so low compared to something that they could be done in Forex, why justify spending significant amounts of capital on entering if the profit's not there yet? Which is why it's up to small businesses and, you know, well, smaller teams to get started, like DAOs and things like that. And on top of that, I had a conversation about this, about the models being different. I mean, like Solana, right? It attracts loads of TradFi traders just from the fact that it's order books everywhere. And then when you go onto EVM chains, it's more AMM-based stuff, or maybe there's an order book off-chain or something like that. But like if you take the traditional players who are processing most of the volume, the models are significantly different, right? So there's new swap markets coming out all the time in DeFi, and I mean, when are we going to see like a concentrated CLAM model on NYC, right? Like,
I also don't think they will go straight to DeFi. They will start with CeFi, especially now that you have more and more exchanges working on off-exchange custody solutions where the TradFi institution can hold their assets in some bank account and T-bills and still trade, for example, on Binance or Kraken or whatever. But they're not going to put money onto a DeFi protocol as long as they keep getting exploited, because why would they take that risk? Like they cannot justify it, I would say.
Well,
It's
absolutely.
just not worth it. And it's also like if they put 50 million, they basically dilute the whole protocol. Like they cannot put serious size anywhere right now in DeFi.
Well, that's the question, really. When it comes down to it, do we think that risk is also going to be a critical factor there? So, of course, we've mentioned earlier in the chat that in the world of concentrated liquidity, we don't really see many strategies that consistently can avoid some of the losses in terms of impermanent losses or other. Do we think that risk is the biggest factor that's holding them out right now, not just, say, embracing these newer models or getting up to speed with it?
No, I think it's scalability, because even if you found that the holy grail of concentrated liquidity LPing, you cannot really put any money at work, because if you go in like plus minus 2% range, you can put a few million at best, and beyond that, the extra dollars you put, they don't attract extra volume. So you just dilute the return that you can make, and I don't think it's very scalable right now, because there's not enough demand yet.
Yeah, so there's many DeFi yield farming funds within this world, right? I know a couple already that have stopped farming due to the risk. And these are very native developers. On stablecoins, maybe you can get 25, 30% per year, but what you're putting at risk is 50, 100 million for, let's say, not that much capital in return of losing all of it. So I think even for native people within this community, they're exiting the game already. Even large protocols like Curve, Curve
Of course,
got hacked, had a mini exploit for some pools. And now with this Athena situation of minting potentially $600 million of DAI, how does that impact the whole ecosystem? So for example, Mark Zeller from Avi wants to put the LTV of DAI down to 0. And, if we start minting more coins, then all of DeFi starts getting affected. So risk is just going up and up and up now.
You said basically what I wanted to say.
Perfect. Well, we just wanted to wrap up for the last part, just to touch there on a famous name that's going to get some last hype as our last topic for the last minute, Athena, and the commentary around the world of Athena. Obviously, in the last few months, very brand new coin offering rather incredible yields that are either loved or hated in the community. There's those who say that it is the next Luna, and there are those who say that it is a darling that generates incredible yields. I just want to ask quickly for the last little wrap-up, what's the thoughts on Athena right now as one of the hottest stablecoins out there?
So I think that's a general rule and not just for Athena. If anywhere on stablecoins you can get above 40% yield consistently, there is a problem somewhere. It's just how it is. And from our side, beside all the normal attack vectors that you have, smart contract risk and stuff like that, we also think that there is a huge regulatory risk, because the way it works, it's basically a centralized provider, one company in Italy that manages your money to provide yield to you, even though that they're not really regulated as an asset manager. So we also see huge attack vectors there just from a regulatory side of view, ignoring all the big DeFi or even economic attack vectors that you would have.
Yeah, I mean, from a technical perspective, I also see quite a lot of risk there. I mean, I don't know, unless they've added other centralized exchanges, the whole thing goes through Binance, right?
I'm pretty sure they use Kraken, Binance, and a few others, but it just seems like a fund that someone's wrapped up in a weird token.
And
I think 65% of all the yield comes from Binance, yeah.
Okay, and in the docs it says, oh, this works so long as the funding rate's positive, and it doesn't say anything else if the funding rate goes negative.
They're also 20% of the open interest as well, I think, on Binance is them.
Okay, so then, yeah, I mean, it's just layers of counterparty risk of, adding Binance on, and then the perp funding rate as well. Yeah.
I always love that statement where they say, as long as the funding rate is positive. It's just like, okay, great, I can have a wonderful suntan as long as the sun is shining. It's a difficult statement to make.
I would say it probably doesn't survive the bear market, but farm it until it dies. I mean, also with Luna, on Luna you could make 20% for a long time, and you were still able to exit if you basically just paid attention what was happening on chain. You saw the outflows before it collapsed. So, yeah.
Well, Colin,
I think many people do this trade already. I think it's a way that they're positioning it as a stable coin. that's quite impactful for the ecosystem. So within 6 weeks of being minted like 15, 20 million up to 600, then putting this potentially 600 million into Morpho that's only been live for 6 months. They've not done one liquidation on the whole protocol. I don't know if it's going to collapse, but there's many factors saying, hey, MakerDAO was very, very cautious for 5, 6, 7 years, and now they've transitioned massively within the last couple of weeks. And I think this can really, really impact the ecosystem, but they should just change it from a stablecoin. It's not a stablecoin.
MakerDAO is not taking any risk with it, though. They have made sure that they can basically exit anytime they want, and the whole risk stays with Ethena. So I think Maker is kind of on the safe side there. They're farming it as well, but with a good approach, I think.
Well, there we are. I think we've been cut off finally at the end. But for any more questions on the world of Athena, of course, you can find us outside. I'd just like to thank all the panelists as well for being here and joining us also. And if anyone has any last questions as well, I'm sure we have about 30 seconds worth of questions left. Yeah.
First of all, a warm round of applause to this wonderful, talented, smart panel with different opinions. It was, my key takeaway, like it depends. So some users might want to know what's behind, some users just want to get from A to B, right? And that was a good also like decentralized. So for example, I'm wearing a DAO t-shirt, but like, but questions. Just raise your hand, we'll find you, just shout. Or it's an apero time, right? You know that. No, please, you have a question.
She said apero already as well. Oh.
No, we'll take it here. Just shout out.
Yeah, no worries. If you could just go per, all the different speakers, what's the most exciting thing you guys are seeing right now?
Woo!
Oh, Mags, you're going to start us off. Let's go.
Exciting.
If someone else has an idea, just jump in.
Shorting restaking protocols. No, I do think that for me, one of the most interesting things that we've been seeing, been developing are protocols like IPOR or Pendle Finance, things that take any yield generating tokens, splitting them up, or creating interest rate swaps. For me, coming from the traditional side, I know that market is absolutely enormous. So seeing that level coming to DeFi is also super exciting because for us institution, it allows us to do so much more.
Wow, yes, true, totally.
I think, there's a lot of innovation coming out with oracles and how that's managed. And the reason I say that is because there's, for example, more complex AMM markets are coming out of DeFi, even though they're not necessarily, blockchain related. You can do them on centralized if you wanted to. But, like the PMM models with oracles, there's a lot going on there. So basically trying to represent more complicated centralized market makers in a decentralized autonomous way and rewarding LPs for that.
We had, by the way, very good talks just before this about oracles and bridging and different approaches to decentralize that. So that was definitely discussed today. But we have maybe one more question or two more. Let me know. Amin, do you have one? When token or retro?
If you give me a beer at the Apro, I'll give you the rest of the Alpha. It's okay.
So that's your address of the Alpha person. Give a round of applause. The guy staying for the Apro, as you heard.
Do I keep my K-pop headphone on?
K-pop, Amin. Woo! Wait, with the tear of Zurich. I think this is the rest of it. Cool, great job.
Guys, if there's any backend Nest.js staff in the room, please ping us. We're hacking on something we need support. Thank you. Or Rust dev.